A teacher from Texas invested just a small amount every month for years and quietly built a portfolio worth hundreds of thousands of dollars. Meanwhile, another investor spent years chasing hot stocks he saw online and ended up losing a large portion of his savings. Both started with the same goal: building wealth. But one simple decision changed everything. Should beginners buy index funds or individual stocks? The answer may surprise you, and it could save you years of costly mistakes. Stay until the end because we'll reveal the strategy many successful long-term investors use to grow wealth without constantly watching the market. Part 1. The investing decision. Every beginner faces. When most Americans start investing, they quickly face a major question. Should they buy shares of individual companies, or should they invest in index funds? At first glance, individual stocks seem exciting. You hear stories about investors who bought a successful company early and made life-changing gains. Social media is filled with screenshots showing massive profits. Financial news channels constantly talk about the next big stock opportunity. It sounds like the fastest way to become wealthy. But there's a hidden reality most beginners never hear. For every stock that becomes a huge winner, many others underperform the market or even lose significant value. That's why experienced investors often focus on something much less exciting, but much more consistent. Index funds. An index fund is designed to track a group of companies instead of relying on a single one. Rather than betting on one business, you're investing in many businesses at the same time. This simple difference changes everything. Instead of depending on one company's success, your investment benefits from the growth of an entire section of the economy. And for beginners, that can dramatically reduce risk. Part 2. Understanding index funds. Let's imagine you walk into a grocery store. Instead of buying one apple and hoping it's perfect, you buy an entire basket filled with different fruits. If one fruit isn't great, the rest still provide value. That's essentially how index funds work. When you invest in a broad market index fund, your money is spread across many companies. Some companies will perform well, some may struggle. But historically, the overall market has continued growing over long periods of time. This diversification is one of the biggest advantages of index funds. Why beginners like index funds? 1. Less research required. Picking individual stocks requires studying financial statements, earnings reports, industry trends, competition, economic conditions. Most beginners don't have the time or experience to analyze all of these factors. Index funds remove much of that burden. 2. Lower risk through diversification. If one company struggles, it represents only a small part of your investment. You're not relying on a single CEO, product launch, or quarterly report. 3. Consistency. Many investors discover that long-term consistency often beats short-term excitement. Instead of chasing trends, they simply continue investing month after month. 4. Reduced emotional investing. One of the biggest reasons people lose money is emotion. Fear causes investors to sell during market declines. Greed causes investors to buy after prices have already risen dramatically. Index funds help many investors stay disciplined because they focus on the bigger picture. Part 3. The appeal of individual stocks. Now let's talk about why people still choose individual stocks. The answer is simple: potential. When a company grows rapidly, its stock can deliver extraordinary returns. This possibility attracts millions of investors. Imagine identifying a successful company before it becomes widely recognized. The gains could be significant. That's the dream. And sometimes it happens. But there's another side to the story. Many companies that look promising never achieve their expected success. Industries change. Competition increases. Consumer preferences shift. Economic conditions become difficult. Even great businesses can experience years of poor performance. That's why stock selection is much harder than it appears. Professional investors spend entire careers analyzing companies, yet even they make mistakes. For beginners, this creates an important challenge. Can you consistently identify winning companies better than millions of other investors? That's not impossible. But it isn't easy either. Part 4. The hidden cost of chasing winners. Many new investors enter the market with a dangerous mindset. They believe investing is about finding the next big stock. So they spend hours searching online, watching videos, reading headlines, following social media influencers, looking for a shortcut. Unfortunately, markets don't reward shortcuts. Many investors end up buying stocks after prices have already surged. Then, when prices decline, fear takes over. They sell. Losses become real. And confidence disappears. This cycle repeats over and over. Meanwhile, disciplined investors continue making regular contributions to diversified investments, year after year, without chasing trends, without trying to predict every market move. Over long periods, this simple strategy often produces impressive results. Part 5. A strategy many successful investors use. Many experienced investors combine both approaches. Here's how. Step 1. Build the foundation. The majority of the portfolio goes into broad index funds. This creates diversification and stability. Step 2. Invest consistently. Monthly investing can help remove emotion from the process. Whether markets are up or down, contributions continue. Step 3. Focus on the long term. Successful investing is usually measured in years and decades, not days and weeks. Step 4. Add individual stocks carefully. Some investors dedicate a smaller portion of their portfolio to individual stocks. This allows them to pursue additional growth opportunities while keeping most of their investments diversified. Step 5. Ignore market noise. Every week there will be headlines predicting crashes or booms. Long-term investors understand that short-term predictions are often unreliable. Their focus remains on steady growth over time. Part 6. The biggest lesson for beginners. The biggest investing lesson isn't about choosing the perfect stock. It's about creating a system you can follow consistently. Because wealth is rarely built through one lucky investment. More often, it's built through patience, discipline, consistency, diversification, long-term thinking. The investors who understand these principles often have a significant advantage over those constantly chasing quick profits. And that's why many financial experts recommend that beginners start with index funds before taking larger risks with individual stocks. Conclusion. So, which is better? Index funds or individual stocks? For most beginners, index funds offer simplicity, diversification, and a strong foundation for long-term investing. Individual stocks can provide greater upside potential, but they also come with greater risk and require much more research. The smartest approach may not be choosing one or the other. It may be understanding how each fits into a balanced investment strategy. Because in investing, success isn't about getting rich overnight. It's about building wealth steadily over time. And that journey starts with making informed decisions today.